Good morning. I'm Vince Lancy. This is the Gold Fix Market Rundown. Today, we have a brand new report from Deutsche Bank. Seems they're getting back into gold. They raised their target 33.50, and they go through the reasons for it. To quote them, it's a special report, and it actually is a special report. They say the magic words about the global reserve currency that others are afraid to say. In premium today at the bottom, we have, well, we've noticed before and during this crisis, we're getting new subscribers from the equity side, and we're happy to hear that. And for all of you that are coming on here as equity people looking to educate yourselves on gold, that's great. My roots are in fundamental analysis, starting on the equity side years ago. So we're not unfamiliar with the terrain. Therefore, I think if you're holding hands with people on gold and talking about what's going on in the markets, you're also talking about stocks. As such, in today's premium section, we've included about 500 words on how to process yesterday's behavior as you prepare for today's marketplace. That's tentatively titled Stocks in Denial and Grasping for Optionality. It's not a doom piece. It's just a reality check. Okay, moving on. There's the home page. Special note, this is the economic reset. People seem to like that. That's one of my favorite graphics that I had AI make up for me like a year ago. We may do something bigger on that. You can see the other pieces there. There's the actual Deutsche Bank story. We just sent that out in an email. Let's go to the markets. 10-year yields are up 1. I thought it was up 21 there for a second, which is what happened yesterday. Trading 421. The dollar is 103.04, down 42. All right. Let me put these in context of yesterday's moves, right? 10-year yields are up 1, continuing an aggressive rally in yields as people sold bonds start as the day went on yesterday. The dollar is 100.04, giving back much of its gains from yesterday, down 42. The S&P 500 is 51.92, up significantly, up 108 points. Yesterday it was lower. The VIX is 40.58, down 6 vols or 13%. Spiked very much early on the day yesterday and worked its way lower, and is continuing lower right now. Gold is 30.16, up 35, right, after having a wild day, opening lower Sunday night, going lower, then being voraciously bought during China hours, with silver being even more voraciously bought during China hours, only to weaken again during the day. Silver 30.33, up only 26 after yesterday's torrid rally, leading the whole metals contingent out of the basement. Copper 424, down 2, continuing to be viewed purely as an economic metal, which is what it is. WTI 61.21, up 13. That's a bounce after a very rough few days. Not much of a bounce, but you get the idea. Natural gas 370, up 9 cents. Marches to its own tune, but it's economic, so it's going to be affected one way or the other. It's hard to really pin it down there. Bitcoin 79,930, up 840. Was extremely weak along with gold during Asian hours, then came out of it and bounced and stabilized. It actually is the lower volatility asset on the board compared to almost everything else right now. Palladium 917, up 9. Platinum 924, up 9. Gold, silver under 100 now, 99 and change. Soybeans, corn, and wheat 986 and change. 460 and 552 and change, up 9, up 1, up 6. Okay, so this whole board here, as a snapshot, not in context of yesterday, this whole board reflects hopes of stimulus. So call it hopes of Fed easing. That's what this board represents right now. Okay, to varying degrees, every market is representing some growing expectation or hope of stimulus. All right. Before we get to our main topic, these are the pieces we put out yesterday. A slide deck on trade war impacts, Founders First Look on the Deutsche Bank report, which we're going to discuss a little bit today. China returns from holiday, aggressively buys silver and gold. That was the morning podcast. We're including it. It's from Sunday. It's over almost 2 days old now. But Hartnett's gold, clearest protectionist winner, not buying stocks just that yet. He gives the laundry list of what to look for. I'll say it again, whether you're looking for a price, whether you're looking for a behavioral, or whether you're looking for a macro indicator of, hey, this could be the end of the sell-off, or this could be the beginning of a bigger sell-off. It's in there. And he writes in a very cryptic style, and we've translated that for readers. Today, Deutsche Bank raises price target to 33.50 on risks to US dollar reserve status. That is a quote. So let's get into that. Deutsche Bank gets back into gold, raises their target to 33.50. Deutsche Bank is raising its price target in the midst of current market turmoil with a brand new report released yesterday. In it, they turn to central bank physical demand, much like Goldman and Bank of America recently have. In addition to the central bank demand analysis, the following are special notes from Goldfix, or noted to Goldfix. The bank discusses de-dollarization not just as an obvious trend, but as a permanent one. Open parentheses, multipolarity, close parentheses. Hi, Kathy. Special observations are made of the underreported gold demand by central banks. What is being stated is not the whole of what is being bought. Now, Goldfix premium subscribers know that already, and some other people have talked about it as well. But the reality of it is they're buying more than they're saying. The rationale for it, Deutsche Bank actually lays out. They say in 2013, the PBOC said we can only buy so much because we don't want to move the market. Because they're buying dips, they want to buy a lot more. And when you extrapolate that forward, what they were saying was you can only buy so much publicly. Anyway, there's a lot of research into that as well. Deutsche Bank also discusses old gold correlations like it's beta to the US dollar, stating they still exist but have flipped their sign, quote, away from being used as reasons to sell gold into powerful catalysts to buy it now. You may remember a little less than 2 years ago, no, it was over 2 years ago, we were talking about the marketplace correlations breaking down as a function of actually mercantilism. Financial correlations became less important and physical correlations increased in importance. That's how we phrased it then. So a strong dollar was not as bearish for gold as it used to be. And about a year ago, maybe a little less than a year ago, banks started discussing this openly. They just couldn't, they couldn't keep it themselves anymore. And while most pundits were waiting for the correlation to snap back, oh, the dollar's stronger, sell gold. Oh, rates are higher, sell gold. Most of our readers and some of the other people out there that are paying attention to these things told people do not think that that will happen this time because they want the gold. That was the whole point of they want the gold. It wasn't about the correlation. Anyway, but Deutsche Bank says that the correlation is back. Similar, but more detailed than what Goldman said about 3 months ago. And the correlation back means it never went away. The whole thing is just resetting. That's the word. And now the correlation is actually a bullish indicator for gold, meaning when the dollar is stronger, gold doesn't care. When the dollar is weaker, gold rips. Okay. ETF demand is also something they discussed. It's cited as a new and increasingly important reason for gold's buoyancy. Now, we know that, right? It's about Western demand from here on in, assuming that central bank demand remains stable, which it has. But they have some special new attention paid to China's growing ETF demand. which has quadrupled this past period. And when you look at the ETF demand in China in context with the new insurance pilot program that's going to expand, we know it, we have the information now. We'll talk about that another time. When you put those two things together, well, you have a global, you have a pandemic of gold buying, if you want to look at it that way. So here we go. Continuing on, Deutsche Bank is getting back into the metals market. In the bigger picture, Deutsche Bank risk analysis represents the German government risk. That implies a new bias to the buy side. Now, that word salad there means Deutsche Bank is a systemically important bank to the government. When they almost went under, Germany freaked out, right? And it's not just, they're structured that way as well. Okay, Germany doesn't have a lot of companies that are publicly traded, and Deutsche Bank is like their baby. Okay, and there are now rumors. I wouldn't even call them rumors anymore. There are discussions that Germany is considering, if not already asking, to have its gold repatriated, and we have that under that link there under German government. So if Deutsche Bank's paying attention to gold, and Deutsche Bank is basically the Robin to Germany's Batman award of the state, well, then you know that Germany is also paying attention to gold. Keep that in mind. The chart there, it's one of several, I think, interesting charts. Visually, Deutsche Bank's charts are not very, they don't pop, but the concepts are good here. So here they are saying this is part of their de-dollarization concept. Central bank demand represents a larger share of gold market than treasury market since 2022. So there are a lot of things you can interpret from that, but I'm just going to tell you what it means. It means that number one, central banks are buying more gold than treasuries. But what it really means directly, without being biased, it means that central banks have a bigger effect on driving gold prices than treasury prices now, which implies central banks aren't adding to treasuries. They're just letting them roll off. There's no central bank treasury demand anymore. No is probably a wrong word, but you get it. Okay. So the full analysis is in Premium today, just sent out, titled Deutsche Bank raises price target to 33.50 on, quote, risks to US dollar reserve status. Markets recap. The S&P 500 and Dow ended lower as Trump dug his heels in on tariffs. We didn't write this, warning that he could further increase levies in China after a report that he might consider temporary relief turned out to be erroneous. Well, that's what the erroneous part is. We'll talk about that later on. Treasury yields gained on rising optimism that some countries may negotiate trade deals with Trump. Gold slipped as investors bought into safe haven dollars on recession fears. Oil dropped on worries of falling global energy demand. In Canada, Canada's main stock index fell after U.S. President Donald Trump threatened China with the additional 50% tariffs, intensifying the U.S.-China trade war. Moving to data on deck. Today is Small Businessmen's Optimism Index, which is not as scientific as some of the other data, but it's forward-looking. So if businessmen say we're worried, then they're worried. People take that to heart, especially when a lot of the data that we're getting now has nothing to do with what happened over the last week. In Premium today, we're not going to read this on the air. We just have it written out for you. Stocks in denial and grasping for optionality. Now, we read something this morning about a half hour ago, and it really was good. And the gist of it is, yesterday during the day, there was a completely false, fake report that I'm not sure where it came out of, but ultimately it was put on Reuters. It was put on, many of the bigger headline terminals, and ultimately they blamed it on a social media person, which is complete horseshit. But the headline basically was Trump is willing to negotiate uh, and put all tariffs on hold for 90 days, except for China, and stocks ripped higher. And so, in the context of a erroneous, false report, the stock market ripped, I don't know, 70 handles. And in the context of all that, that tells us that stocks are in denial and grasping for optionality. So it means beware. You may have a bottom, but you certainly don't have stability. Going to the markets, the charts, go back to the charts here for a little bit. All right, so let's just look at the dailies here, okay? Gold, a bounce after that horrible day yesterday. A nice bounce, increasing actually. The S&P 500, huge wick below, bounce today. This could be a bottom. I mean, it could be a bottom. It really could be. Bitcoin, similar to stocks. There's Bitcoin acting like a stock. That's the Chinese stock market. Okay, so pretty much nowhere right now. Let's take a look at, let's focus on silver, right? That was where the fun was yesterday. Okay, so silver, chart-wise, is acting like stocks, right? Okay, that's very interesting. I want to go to copper for 1 second. Copper is acting like Chinese stocks, right? Down, down, gap, stop, unchanged. Silver, down, down, bought by China, but bought, right? And then next day follows through higher, acting like stocks. So I say with a little more confidence now that this market is, I mean, I was confident, but now I'm really confident. This market is really hoping for a cut, or it's starting to factor in a cut. And yesterday's silver move was probably a gold silver person also unwinding for different reasons from different venues. But look, this is where we are now, right? I think the market really is looking for a steepening, a bull steepening, meaning the Fed lowers rates. The long-term rates could go up too, but that's it. There's the markets. Gold is up 32, very encouraging. Stocks. I mean, let's we never talk about stocks here. Let's talk about it. Look, that could very well be the silver chart, right? Okay, no levels today. I'm Vince. Be sure to check out our premium content today. And there's the homepage. Have a great day.